This particular video is on the Excel methodology that we're going to use to evaluate our sharp optimal portfolio, our minimum variance portfolio, and compare those to the overall market by using the S&P 500 as proxied by the ETF SPY, also known as a SPDR. So your first task is going to be to download daily data. You'll notice that my daily data here starts on 4/14 of 2014, and then we need at least 500 observations. I have 512 observations, daily observations, -1 for the top, so 511, and we end here on 4/2/2012. You're going to need to download these daily observations for all the stocks and ETFs that are in your portfolio. That's the first step that you're going to need to take care of. The next one is to go ahead and form your prices tab. In this case, we just have the prices of each one of the stocks, and we have the prices of SPDR, SPY, and you'll notice that I've also downloaded the SPY daily price data, in this case from Yahoo Finance. Next step is to go ahead and develop our return tab. Returns again are calculated as prices of today minus prices of yesterday divided by prices of yesterday. We'll generate each one of these return tabs, return series. Now these are the returns for each individual stock, and what we really need is the portfolio returns. So this is from the portfolio optimization worksheet. We have our risk-free rate and expected market return. Our sharp optimal portfolio, or my sharp optimal portfolio, with its weights 47, 18, 5, 9, and 20, and the minimum variance portfolio also set up. Now I've transposed these numbers so that I can easily use the Excel function of sum product. I've also copied over the portfolio betas, the expected return in the portfolios. This is on an annual basis. The expected volatility of the portfolios, again on an annual basis, and what I'm predicted as what my Sharpe ratio should be. And we're going to start with an initial investment. We're going to say I have 200,000 bucks. So the idea here is on the first day of our daily data over here, that we in the morning we invested, or the night before we invested $200,000 in our portfolio, and we want to track its performance. So in order to calculate the portfolio return, here we're using the sum product portfolio weights multiplied by the return. Now you'll notice that the portfolio weights have the dollar signs in front of them so that they remain constant as I drag down the valuation. And what it is doing, it is taking the weight of 47% and it's multiplying it by the return of 0.05, or 0.5% return. And then it's adding it to the weight of DuPont, which is 18%, and it's multiplying it by the return of DuPont, which is 0.7% or 0.07, and so on and so forth. Okay, so that gives me my portfolio returns. Over here, what I'm calculating is the actual values. And critical here is at the bottom. What we want is to have our $200,000, which is what this number is here. Portfolio weight C17, 200,000 bucks. Portfolio weight C17, and we're multiplying that by 1 plus the return on our first day, which was negative for the portfolio, so it dropped the value of our overall. The next one up, what we want to do is take our existing portfolio value, that's the end of the first day, and add to that the change in the portfolio value, which is our closing price times the return for the next day. So in this case, we had 2 negative returns on this portfolio, and the portfolio decreased in value each time. and we'll do that for the minimum variance portfolio and the S&P 500 spider stock, and drag those up. And these represent the total returns that we're getting. Next thing you want to do is create a plot that compares the value of our three portfolios. In order to create the plot, I want to come over here back to my portfolio returns. We're interested in these three columns. So I'm going to start by going ahead and highlighting the value series for my Sharp Optimal. And again, this is just one way to do the plot. There are some more efficient ways, but this is the way I'm going to show you because I think it's going to be clearer. And I want to insert, and then I'm interested in a line plot. And you look at this and say, well, it's going down in value. And actually what that means is that the dates are in reverse order. And I'm going to go ahead and move this chart location to a brand new sheet just called Chart 1. Alright, and what we want to do is click here on the Select Data, and what we're going to edit is our reference numbers. So in this case, we're going to come back to our portfolio return, and we're going to pick our dates. Like so. And hit OK. And we're going to OK it. Well, I'm not going to OK it again, but you can see that now there's an inversion, that Excel knows the order of the dates. It goes from earliest to latest, and therefore we're getting the plot that we're looking for. We're going to edit this series real quick, and this one is called Sharp Optimal. Alright, and we're going to add another series to it. And the next series is going to be our minimum variance. And then we select our data values here. And add our final series, which is SPY. And series information. And I'm picking the first one, I'm pulling down to the bottom, I'm holding the Shift key and clicking the last one, and that selects everything. Alright. Okay. So one of the other things we're really interested in here is the fact that the scale is a little bit off. It's going from 0 up to 350,000, not really giving us the look that we want to get an accurate picture, visual picture. So we're going to click on the axis and then right click to format the axis. And what we want to do is set the minimum, just visually I'd say 180,000. 180,123, and the maximum, let's call it 320 or 310. Either one would be fine. And we're good. We also want to add a little bit of additional material here. We can go ahead and format our plot area by adding a border to it. That's going to be black. And we can also format our plot area, or what I want to do is actually look at our axis options and put a chart title on and additional information, so that it ends up looking like our portfolio plot here. We have date at the bottom, dollar value on the side, and a performance comparison of the three plots. And I'm going to let you guys work on the details, actually, now that I think about it, of how to finish off the plotting. Okay? Alright, the last thing we want to do is our comparison, our expected annual return. just comes from our predicted value here, 10.99. An expected daily return, you'll notice, is the expected return divided by the number of days in a stock year, which is 252. The annual percentage return is the actual average annual return, you'll see, is 252 times J3, which is our 252 times C7, which is right below. And this one is just the average of returns over the portfolio. In other words, what we want to do is say we want this to equal the average and then on our portfolio return we're highlighting or selecting the actual return of our portfolio. Now these are daily returns. Which means if we multiply the average daily return by the number of days in a year, we end up with our annual return that we would expect. The expected volatility is coming from the prediction and our optimization. The expected daily volatility is the annual volatility divided by the square root of the number of trading days in a year. The actual annual volatility, we're going to start down here. We're using the standard deviation. So this gives us the volatility, the daily volatility of the portfolio, which is basically 0.7%. And then in order to get the annual volatility, we're multiplying that by the square root of the number of days in a year. Finally, with all this information, the expected Sharpe ratio we're bringing in from the portfolio analysis, and our actual or achieved Sharpe ratio is the actual return that we got of 19.44% per year. Put this. All right, minus the risk-free rate as quantity, then divided by our actual annual volatility of 12.4%. Now, one thing about this predicted return, or the expected return up here, that it was based on the market actually returning 10%. But the market itself returned 15.4%, therefore the CAPM implies that our Sharpe optimal portfolio should have achieved almost 17%, while our minimum variance portfolio should have only achieved 12.35%. You can see that the minimum variance portfolio actually outperformed significantly. And when we want to compare how well our portfolio did against the spider, what we're interested in is the Sharpe ratio. It's the amount of return that we achieved per unit of risk that we took on. And obviously we want the highest return per unit of risk. And what we see here for my portfolio, the Sharpe optimal outperformed the market rather handily. That's not to say that in the future the market may not outperform the Sharpe optimal portfolio. But people say, what stock should I buy? This is the process of finding out ones that you think are going to perform well, and then how much should you buy is this Sharpe optimal weighting process. All right, and the final thing we do here is compare the total return. That's the ending value of the portfolio minus our 200,000 divided by 200,000. So over the holding period, we got 46% return on the Sharpe optimal, 41% return on the minimum variance, and 35% return on the S&P 500. All right, and that is the comparison. This is the mechanics of the Excel part of it, and there is a write-up that's due, and that information is posted on the website. Thank you much. Bye.